Number one, a security market index represents the risk of a security market as a whole, or security market, market segment, or asset class. This one here is C. Let's see if we can eliminate these other two. Represents the risk of a security market. You may read that and go, but yeah, we did that all in portfolio management. Come on, man, what are you doing? The security market index is a proxy for risk in a security market. It is not a measure. It is not a measure of risk. Make sure you get that distinction. That'll trip you up at least once or twice. A security market as a whole. It's saying a security market index represents the security market as a whole. Well, no, it doesn't. I mean, it could, but that's not enough. It could, but this is suggesting that that is what it does. That it's limiting you to, well, it just represents the market as a whole. It represents the security market, the market segment, or asset class. 1 month after inception, the price return version and total return version of a single index, consisting of identical securities and weights, will be equal if market prices have not changed. Capital gains are offset by capital losses. The securities do not pay dividends or interest. Price return versus total return. Remember the difference in the numerator, right? It was the value at time 1 minus the value at time 0 over the value at time 0 plus I. So this is the same in both. This is for total return. So the only way they can be equal is if this is equal to 0. The securities do not pay dividends or interest. The values of a price return index and a total return index consisting of identical equal weighted dividend paying equities, we got dividend paying equities, will be equal only at inception and on rebalancing dates, at inception and on reconstitution dates. Well, they're paying dividends. So we know that we're going to get income. So remember that numerator now has a term that is different in both formulas. So it'll only be equal when that term is 0 at inception. It says at inception on rebalancing dates. Well, we don't know how many dividends will be paid up to that point. And same with reconstitution, only at inception. Actually, the more proper answer is only at inception and up to the point of the first dividend payment. Because the very next day, if nothing paid a dividend, they'll be identical. The next day, if nothing paid a dividend, they'll be identical. Up to that first dividend, they'll be identical. But we can say only at inception. Security market indices are constructed and managed like a portfolio of securities. Simple interchangeable tools for measuring the returns of different asset classes, or valued on a regular basis using the actual market prices of the constituent securities. And on this one, you may be looking at and going, but I agree with all three. And I'll admit that this is one of those questions that are tricky because it is based on vocabulary and words and trying to trick you with just the type of wording that it uses. And I don't like these kind of questions that rely on that kind of wording and that kind of word trickery. Let's start with the last one and eliminate it. Valued on a regular basis using the actual market prices of the constituent securities. Typically, yeah, except it says here security market indices are doing this. Well, we can take an index like a real estate index and look at the appraisal index. Well, the appraisal index is not based on the actual market prices of the constituent elements. It's based on a guesstimate of what it is, so we can eliminate that because of this wording right here. Simple interchangeable tools for measuring the returns of different asset classes. Well, yeah, they measure the returns of different asset classes, but they are not interchangeable. They are specific to that particular asset class. Constructed and managed like a portfolio of securities. You have to select A. I'm going to tell you right now, I'm not a big fan of questions like this that turn on just the difference in the wording that's used. I don't like that idea. When creating a security market index, an index provider must first determine the target market, appropriate weighting method, or number of constituent securities. We must first select our target market to define our universe of stocks that we select from, or universe of securities. Number 6, and I'm going to show you something here with these types of questions because you're going to get a few of these, and I'm going to show you something that's going to save you. Trust me on this. An analyst gathers the following information for an equal-weighted index comprised of assets Abel, Baker, and Charlie. Equal-weighted. The price return of the index is Pay attention. It's because it's easy to slip. If I calculated a total return, one of these answers will be a total return. One of them will be a price return. You'll calculate total return. You'll look, you go, aha, there it is, and you'll circle it. Make sure, circle it, big, price return. I'm looking for price return, which means I'm not going to consider income. I don't even care about this last column. You're going to fall into that trap. Here's why. Because if you calculate it with this, one of these answers will be right. You will get 11.4% on a total return. There it is. That will be the wrong answer. We only want a price return. So, what do we got? We need the return that we have multiplied by its weight. So in this one, it's rather easy to do, I think. What do we have? We have beginning of period 10, end of period 12. So we have 2 over 10 multiplied by 1/3. That's its weighting, equal weighted. Plus, we have 20 minus 19. We have negative 1 over 20 multiplied by 1/3. Plus, we have 30 and 30, 0. So we just have to calculate these two. Here you'll get 0.06666 plus, and this will be a negative 0.016 repeated, which will give you 5.0%. If you had calculated total return, you would have got 11.4. You would have found it. It would have given you some comfort that you found it. Aha, I got the answer. There we go. Off I go. You'd be wrong. Careful about this price and total return. You want to circle it and you want to say price, I don't care about income. Total, I care about income. If you don't care about income, cross it off, get rid of it, and just focus on what you need. Price, price. It says right there. An analyst gathers the following information for an equal weighted index comprised of assets Abel-Baker charting. This is the same thing we had on the last problem. The total return. Now we're looking for total return. Now we care about income. Now we care about income in this sense. So all we have to do is just calculate what we have. What do we have? We have 10, 12, we have 2.75. So we have 275 over 10 times 1/3 plus 20. We have a negative 1, but we got a 1. That's a 0. That's a 0 return. Plus 30, that's a 0 return here, but we got 2. 2 over 30 times 1 over 3 because it's equal weighted. And if you do that out, you'll get 11.38%. If you multiply these out, there's your 11.4. So be careful now. Total return, price return, make sure. Spend the time, read carefully, make sure you know exactly what you're being asked and solve that. Don't read it and say, find the return. Okay, I know how to do this. Slow down. What's being asked? Total. An analyst gathers the following information for a price-weighted index. That was equal-weighted. Now we're on price-weighted, comprised of securities A, B, C, D, E, F, G, H, I. There's our beginning period, end of period, total dividends. The price return, we don't care about dividends. Make sure you do that. Make sure you're aware of that. We only want the price return. For price return, we could do it two ways. You could do it the long way, and you can calculate the price change on each one, and then calculate and then weight each one. Or you could just say, well, it doesn't really matter. Let me add up the beginning period price. We got, what do we got, 40, 60, we got 75 is the beginning period price. The end period price is, what do we got, 20, 40, 47, 52, 68. 68 minus 75 over 75. The ending period price over the beginning period price divided by the beginning period price will give me negative 7 over 75. And what did I get on that? 9.33%. Negative 9.33%. There it is. The other way to do it is just to do each one knowing that the total is 75. So your first one is you have a difference of 2. You'd have 2 over 25 weighted by 25 over 75. Plus the next one would be negative 10 over 35. Weighted by 35 over 75. And of course the next one would be 1 over 15 weighted by 15 over 75. You'd still get the same thing. With a price weighted, it's easy enough to know that, look, beginning period, let me add it all up. Let me add all this up and calculate the difference. You get the same thing. An analyst gathers the following information for a market cap weighted index comprised of securities MNO, QRS, XYZ. Here we are. The price return of the index is, so I don't care about this. Let me see if I can get that. I don't care about that. So the price return is, well, the first thing I need to know is what my market caps are. So here's my beginning of period price. Here's the number of shares outstanding. So make sure you get these two columns straight, right? That's the price, that's a share. So what do I have? I have 2,500 times 5,000. This will give me 12.5. Next I have 3,500 times how many shares? 7,500. This will give me 26,250. Then I have 1,500 times 10,000 times, I'm just going to put 10K here, and that'll give me 15 million. So my total market cap, if I add them all up, is 53,750. Now I could then find the difference here. I have 200 over 2,500, so I could take that route. I got 200 difference, 200 gain over the initial price of 2,500, and weight that by 12.5 over 53.75 plus, and do the next one and the next one. Or I could just say, well, let me use the end of period prices times the shares outstanding, figure out what the total, what the change in value is. And since the shares have not changed, all change must be due to price, and there is my price return. So if I calculate 2,700 by 5,000, I will get 13.5 million. If I take 2,500 by 7,500, I get 18.75 million. And if I take 1,600 by 10,000, I get 16 million. If I add this up, I have 48.25 million. So there we go. So all I have to do now is take my ending value, 48.25 million, minus my beginning value, 53.75 million, over 53.75 million. And I will get 10.23, negative, because that's a negative in my numerator, 10.23%. There we are right here. You can get it this way by weighting each of the components, or you could just get it directly. Whichever way you like to go, it's up to you. Number 10. Let's see, where are my notes for 10? An analyst gathers the following information for a market cap weighted index comprised of securities. Well, it's the same securities that we have. Notice that these two are the same. What is the total return of the index now? So we want the total return of the index. So on this one here, what I would do is, since I've already calculated this one here, I would follow the same process. I would calculate the beginning market value, 53.75. Then I would calculate the ending market value, but just add on the value of the dividends. So my beginning was 53.75. I'll stick with that. I just need a different number other than 48.25. I need a different number. So what are the value of the dividends? Because I'm going to add it. Remember, I just simply take this and I add it to the numerator. So I just need to add that to the numerator. So let's go. What are my dividends? Here's my dividends per share. Let me get a better color that prints on that. There's my dividends per share. There's my outstanding shares. So let's go. I have 100 times 5,000. 5,000 shares. Dividends per share is 100. This is 5,000 shares. And that gives me 500,000. 100 times, yep, 500,000. I got lost there for a second. Then 150 times 7,500 will give me 1.125 million. And I have 100 times 10,000, which will give me 1 million. So if I add these all up, I will get what, 2.625 million. So I will just add 2.625 million to my numerator here. That will give me 48.25 minus 53.75 plus 2.625 will give me negative 2.875, and I use the same denominator, 53.75. And I will get negative 5.348. Negative 5.348%. I want to make sure I get a negative there. Negative 5.35. So just so you know what this is over here, this is the value of the price return index at time 1 minus the value of the price return index at time 0 over the value of the price return index at time 0. For a total return, it is the value of the price return index at time 1 minus the value of the price return index at time 0 over the value of the price return index at time 0 plus any income during that period of time. So this was already calculated here. All we needed to do is say, well, what's the income? Add that to the numerator, and there we go. Notice that here was negative 10.23. Was the total return index higher than the price return? Negative 5. It's higher than negative 10. Yes, it was. 11. When creating a security market index, the target market determines the investment universe, is usually a broadly defined asset class, determines the number of securities to be included in the index. The target market determines the investment universe. Number 12. An analyst gathers the following data for a price-weighted index. The price return of the index over the period is, so here's our beginning of period, price and shares, end of period, price and shares. And this is a price-weighted index. In a price-weighted index, we assume that there is one share of every component. We don't really care about the number of shares. All we care about is the price. We're just weighting it by its price. So our beginning period price is $96. So beginning equals 96. End is 70 is 100. So ending period minus beginning period divided by beginning period will give us 4.167. 4.167%, 4.2, can we round it off there? So that was a little bit tricky, asking you see if you wanted to multiply by its shares, but remember, price weighted, we just add up the price, we assume one component of each share. An analyst gathers the following data for a value-weighted index. The return on the value-weighted index over the period is, so we have to figure out the return. So on this one, we are going to multiply by the shares because we want the value of what we have, not just the price, but what's the value of our position. So in our first one, 20 times 300, that'll give us 6,000. Then we have 50 times 300, that'll give us 15,000. Then we have 26 times 2,000, that gives us 52,000. So the value started at 73,000. Ending period, we have 22 times 300, that gives us 6,600. 48 times 300 gives us 14,400. And 30 times 2,000 gives us 60,000. So if we add all that up, we'll get to 81,000. This is beginning, this is ending, that is all we need. Ending period minus beginning period, I'm just dropping all the zeros now, divided by beginning period will give us 10.96%. 10.96, we have an 11, I'll take the 11, call it close enough. There we go. Number 14, an analyst gathers the following data for an equally weighted index. The return on the index over the period is, well, this is equally weighted now. So each one is weighted by a third. So here is 20 to 22. We're up $2. So we have a return of 2 over our initial amount of 20. Now the 2 is just a shortcut. I could put 22 minus 20 over 20, but I'm just putting the 2. This is 48 minus 50 over 50. That'll be negative 2. So the next one will be negative 2 over 50. And our third return is 26 to 30 is 4 over 26. And they're equally weighted, so we weight each one by 1/3. That's it. So you just weight each one by 1/3. We'll get 0.0333 plus negative 0.01333 plus 0.051282, and that'll give us 7.1282%. 7.1282, 7.1. It's rounding down to 7.1. I guess we can take C at 7.1. Which of the following index weighting methods requires an adjustment to the divisor after a stock split? Price weighting, fundamental weighting, or market cap weighting? Which one requires an adjustment after a stock split? Well, when we have market cap weighting, a stock split doesn't change the market cap. It changes the price and the number of shares, but it doesn't change the market cap. Fundamental weighting, well, if we're weighting it by revenues, who cares if there's a stock split? Revenues will still be the same. Any fundamental value will still be the same. It has nothing to do with shares. Price weighting, yes, because after a stock split, the price is cut in half. So, A. If the price return of an equal weighted index exceeds that of a market cap weighted index comprised of the same securities, the most likely explanation is, so here we're saying a price return of an equal weighted index was greater than the market cap weighted. Stock splits, dividend distributions, or outperformance of small market cap stocks. You'd have to go with C. In a market cap weighted index, these would have very low weightings. But in an equal weighted index, they would have higher weightings. So if they outperformed with higher weightings, the price return would be greater than the market cap weighted return, because the price return would give them, well, not the price return, the equal weighted index would give them a higher weighting. A float-adjusted market cap weighted index weights each of its constituent securities by its price and its trading volume, the number of its shares outstanding, the number of its shares available to the investing public. Well, it is float adjusted, so it would be the number of shares available to the investing public. Which of the following index weighting methods is most likely subject to a value tilt? What's a value tilt? That means overweighting undervalued securities, a contrarian effect. Equal weighting, fundamental weighting, or market cap weighting. We said market cap weighting would tend to overweight companies that went up in price because they would have a higher weighting in the index. This is momentum driven. We can get rid of that. Equal weighting is always equal. It makes no distinction. Fundamental weighting has a value tilt. Value tilt meaning that it'll underweight overvalued securities and overweight undervalued securities. 19. Rebalancing an index is the process of periodically adjusting the constituent securities weights to optimize investment performance, securities to maintain consistency with the target market, or securities weights to maintain consistency with the index weighting method. So rebalancing is adjusting weights. Reconstitution is adjusting the securities. So we can eliminate B. Reconstitution is doing that. So why are we adjusting weights? To optimize investment performance or to maintain consistency with the index's weighting method? It is to maintain consistency with the weighting method. Optimizing investment performance, well, that's a fund manager that does that by, if their benchmark is the index, by either underweighting or overweighting certain components in their tracking portfolio. 20. Which of the following index weighting methods requires the most frequent rebalancing? Price, equal, or market cap weighting? Well, we did this in the review. We specifically said price will rebalance itself because as price changes, the weightings change. For market cap, well, as the number of shares outstanding and the price changes, the market caps change, and hence the weightings will change. Equal weighting. You have to do a lot of rebalancing there. 1. Reconstitution of a security market index reduces portfolio turnover, the need for rebalancing, or the likelihood that the index includes securities that are not representative of the target market. Reconstitution means we take some out, we put some in because the index has drifted away from its target market for a while. So, C, reduces the likelihood that the index securities are not representative. Security market indices are used as measures of investment returns, proxies to measure unsystematic risk, or proxies for specific asset classes and asset allocation models. Here we're saying A, measures of investment returns. Well, no, it's not measures of investment returns. It's a measure of market return, not investment return. So we can say no to that. Again, turns on wording. I don't like that. Proxies to measure unsystematic risk. Take off the un and you'd be very close, so we can eliminate that. Proxies for specific asset classes and asset allocation models. There you go. C. Uses of market indices do not include serving as measure of systematic risk, basis for new investment products, benchmark for evaluating investment portfolios, benchmark for evaluating portfolio performance. They do not serve as measure of systematic risk. Number one, they serve as a proxy, but not as a measure, not as a direct measure. It's a proxy for the measure. So we can say A, basis for new investment products. Yes, they do. Market indices do serve as a basis for new investment products, and they do serve as a benchmark for evaluating portfolio performance. 24. Which of the following statements regarding sector indices is most accurate? Sector indices, A, track different economic sectors and cannot be aggregated to represent the equivalent of a broad market index. That's not true. You have the S&P 500, which is a broad market index, and the S&P 500 has 10 sectors, and each of those sectors has an index. And these indexes, the components of the index, are all independent of each other, but when you add them all up, you get the S&P 500, you get the broad index. We can eliminate that. B, provide a means to determine whether an active investment manager is more successful at stock selection or sector allocation. Yeah. Let's read C, see if we can eliminate that or if we have a conflict. Apply a universally agreed upon sector classification system to identify the constituent securities of specific economic sectors such as consumer goods, energy, finance, and healthcare. Not really. This is sort of saying that you can only have indices that follow this sector classification system. You can have an index of securities that cross multiple sector classification systems. So we can eliminate that because it's too restrictive. And B is correct. So let's read what we had. Which of the following statements regarding a sector index is most accurate? A means to determine whether an active investment manager is more successful at stock selection or sector allocation. Yes. Which of the following is an example of a style index? An index based on geography, economic sector, or market capitalization? Well, geography and economic sector, there's really no style there. That's just sort of an allocation to a particular region or to a particular sector of the economy. But market cap, that's a style in that. Mid cap, small cap, large cap. Which of the following statements regarding fixed income indices is most accurate? Liquidity issues make it difficult for investors to easily replicate fixed income indices. Rebalancing and reconstitution are the only sources of turnover in fixed income indices. Or fixed income indices representing the same target market hold similar number of bonds. So let's see if we can eliminate some of these. We'll start at the bottom. Fixed income indices representing the same target market hold similar number of bonds. Well, that's not true. You could have an index representing the same target market, let's say corporate debt, but have a different weighting system for how they determine the constituents. So they don't have to hold similar numbers of bonds. There's no rule that says they have to. They may, in which case, why would you replicate an index that already exists, right? Rebalancing and reconstitution are the only sources of turnover in fixed income indices. No, bonds mature. So they don't have to be rebalanced or reconstituted. They mature and they disappear. Hence, they're just gone. So you have turnover. So we can eliminate that. We're left with A. Liquidity issues make it difficult for investors to easily replicate fixed income indices. Yeah, that's true. Some bonds that make up some index may not have the liquidity needed for a manager to replicate the performance of that index. 27. An aggregate fixed income index. Aggregate fixed income index comprises corporate and asset-backed securities, represents the market of government-issued securities, can be subdivided by market or economic sectors to create more narrowly defined indices. Well, if it's aggregate fixed income, it says here comprises corporate and asset-backed. Well, where's government in there? That's too narrow. Represents the market of government-issued securities. Again, that's too narrow. That's not broad market. You're left with C. 28. Fixed income indices are least likely constructed on the basis of maturity, type of issuer, or coupon frequency. Well, we can see that we have indices by maturity, corporate, government, by type. By maturity. I was going on B. Now that I'm there, let's just say by type of issuer, corporate, government, by maturity, money market, capital market, long-term bonds, short-term bonds, medium-term bonds. Coupon frequency, you're not going to find an index that are quarterly bonds or semi-annual bonds. So they're least likely to be constructed on the basis of coupon frequency. In comparison to equity indices, the constituent securities of fixed income indices are more liquid, easier to price, or drawn from a larger universe. Well, we've already had a question before about the difficulty of bond indices, that some of the components might not be liquid enough for managers to track. So we can't say that bonds are more liquid. In fact, they are actually less liquid, so we can get rid of that. Easier to price? Well, stocks we can look in the security market and see the price. Bonds, that's a dealer desk. We have to call and get quotes, and maybe one dealer will have different prices than another dealer. So there is a price discovery method you have to go through. It's not as easy as looking, so I wouldn't say they're easier to price, but this is true. They are drawn from a larger investment universe. There you go. Lots of terminology. The big thing in this one here is you should be able to calculate the returns on price index and total return, and don't get messed up. On the question, when you see price return, circle it and say, I don't care about income. When you're looking at total return, say it's a price return plus income. There you go. Commodity index values are based on futures contract prices, the market price of the specific commodity, or the average market price of a basket of similar commodities. We were clear on this in the review. The commodity index is based on futures contract prices. Which of the following statements is most accurate? Commodity indices all share similar weighting methods. Commodity indices containing the same underlying commodities offer similar returns. The performance of commodity indices can be quite different from that of the underlying commodities. Okay, well, let's eliminate some. Commodity indices all share similar weighting methods. No, they don't. They can be weighted differently. Commodity indices containing the same underlying commodities offer similar returns. Well, no. You can have two indices that have the same underlying components but have different weighting methods. So the weighting, as we've already seen if you've been through the regular lectures I did on this one in the playlist, can result in different returns based on how you weight them. C. Performance of the commodity indices can be different from that of the underlying commodities because they use futures contracts. Which of the following is not a real estate index category? An appraisal index, an initial sales index, or a repeat sales index? Well, we talked about appraisal index and we talked about repeat sales index, right? Initial sales index is not a real estate index category. A unique feature of hedge funds indices is that they are frequently equal weighted, are determined by the constituents of the index, reflect the value of private rather than public investments. Well, I think we can eliminate C. Hedge funds make public investments. They buy shares of companies, so I think we can eliminate C. So are frequently equal weighted or are determined by the constituents of the index. We made a point about this, that if you're if you're in charge of the S&P 500, you determine the components. But since hedge funds can choose which index they report to, the hedge funds actually determine the index. They are determined by the constituents of the index. The returns of hedge fund indices are most likely biased upward, biased downward, or similar across different index providers. Well, if I can choose to report or not to report, and I can choose who to report to, I'm only going to choose to report if I got something really great to report. So typically, of all those reporting, they'll tend to be the ones that want to report. The ones that did poorly won't want to report, so the results of the index will be biased upwards. Will be biased upwards because if I did bad, I'm not telling you.